Right now, the entire U.S. stock market, including your 401k and your index funds, is being held up by a single, very specific story. The belief is that American tech companies are going to generate trillions of dollars in AI profits because the rest of the world will be forced to buy their technology. But look closer at the enterprises actually expected to pay those trillions, and you find a massive gap between the marketing and the math. Tech giants are promising to help companies build billion-dollar ideas, yet they aren't charging for those results. Instead, they use token pricing. A token is basically a piece of a word. Every time an AI reads your prompt or writes a response, you pay for that usage. You are billed whether the answer is a brilliant business strategy or a useless hallucination. This pricing model is causing friction. Alex Karp, the CEO of Palantir, notes that corporate leaders are frustrated. They are paying massive subscription fees for a technology whose ROI cannot be measured, and they aren't seeing the billion-dollar efficiencies they were promised. Corporate America is essentially paying blind fees for unmeasurable outcomes. Because of that, the foundational story keeping the stock market at record highs is starting to show serious cracks. A second fear is growing among these CEOs. Their AI vendors might be absorbing their trade secrets. When a company feeds its internal data into a major model, that AI starts learning the specific special sauce that makes the business profitable. We've already seen this happen. Anthropic recently launched a design tool that directly shocked its partner, Figma. After working closely with the AI firm, Figma watched their own vendor release a product that looked suspiciously like a replacement for their own software. To protect their IP, major corporations are changing tactics. Instead of renting cloud-based models from big tech, they are downloading smaller, specialized AI models to run on their own hardware, entirely offline, where no vendor can look at their data. The most lucrative potential clients for big tech's AI labs are actively pulling back. They are refusing to hand over their data, which means they are also withholding the massive budgets these labs need to survive. To see why those budgets are so critical, we have to look at how tech companies historically made their money. For decades, they relied on the software model, the most profitable business structure ever invented. Usually, a company spends money once to build a program, like Excel. After that, their costs stay flat. Since they can sell infinite digital copies, revenue skyrockets while expenses remain the same. That gap is pure profit. Generative AI breaks this model. It functions like a restaurant. Every query requires electricity and specialized chips to calculate the answer. This means costs rise linearly with revenue. As the business grows, expenses grow right along with it, preventing that profit gap from opening. This creates a cash burn unlike anything seen in tech history. In just 1 year, OpenAI reportedly burned through $20 billion. The physical infrastructure required to sustain this is reaching an impossible scale. Oracle is currently building data centers that require the power of several nuclear plants, supporting a single AI client currently losing billions. The AI boom currently operates as an expensive industrial project fueled by debt. It lacks the high-margin profitability that investors have come to expect from the software era. American tech companies are burning these billions under the assumption that they will maintain an absolute global monopoly. The spending only makes sense if the world has no other choice but to use U.S. technology. But China found a shortcut. Instead of spending billions on foundational research, Chinese labs use a technique called distillation. They have their models study the answers generated by the massive American models, effectively copying the homework and bypassing the expensive research phase. Look at the difference in spending. The U.S. is projected to spend roughly $1 trillion on AI infrastructure. China is achieving similar results at a fraction of the cost, with a projected spend of just $123 billion. Chinese developers are now releasing open-source models that match 90, slowing down for emphasis. Analysts are now watching for 2 specific warning signs. The first is a pullback in infrastructure spending. The moment a major CEO announces they are slowing down their AI investment, it gives every other company permission to do the same. The second sign is in the bond market, specifically credit spreads. This measures the extra premium lenders demand to cover the risk of a company going broke. If lenders become worried that these data centers can't pay their bills, these spreads will explode. We are already seeing signs of doubt. Michael Burry, who famously predicted the 2008 housing crisis, recently highlighted data showing how Wall Street is quietly cooling on the AI story. The data shows a massive disconnect. Stock prices for companies selling chips are skyrocketing, but the stock prices for the tech giants actually doing the buying, the companies spending the trillions, are almost flatlining. The market rewards sellers while expressing deep doubt about the buyers. Generative AI works as a technology, but the trillion-dollar story driving our retirement funds relies on a fragile economic foundation. It is a story waiting for a single pin to drop.